Overfitting has quietly destroyed more trading accounts than bad entries, bad brokers, and bad luck combined. In one study, Harvey and Liu found that out of 447 published equity factors, most were likely false positives about patterns that vanished out of sample. Harvey, Liu, and Zhu, 2016. Institutional quants know this, which is why many funds require years of live or walk-forward evidence before risking serious capital. Retail traders? They often risk real money after a weekend of curve fitting. In this video, we're going to fix that. If you backtest your own strategies in Python, MetaTrader, TradingView, or any platform, this episode matters more than your next indicator. I'm going to show you why most algo systems fail in live trading, the specific statistical traps causing it, and a practical checklist you can apply to your own code tonight. We'll cover how overfitting sneaks into even simple strategies, the difference between a robust edge and a lucky backtest, concrete techniques, out-of-sample testing, cross-validation, and realistic assumptions. By the end, you'll know how to kill 90% of bad ideas in simulation instead of in your brokerage account. Start with the basic problem. Historical data is finite, noisy, and full of randomness. If you search hard enough, you will always find something that would have worked. Harvey, Liu, and Zhu, 2016, reviewed hundreds of published equity factors and concluded that the literature suffers from severe multiple testing. Too many variables tried on the same data. Bailey et al., 2014, estimated that when quants test thousands of variations, most profitable strategies are just statistical flukes that will not repeat out of sample. For retail algo traders, the same logic applies. Run 1,000 parameter combinations. Just keep the top 10 sharp ratios. Congratulations, you've mostly captured noise. Consider this. If your null hypothesis is no edge, and you use a 5% significance level, then on average 1 out of 20 random strategies will look statistically significant by pure chance. If you try 500 variations, that's 25 fake edges expected just from randomness. Then we stack more problems on top. Ignoring execution costs, Frazzini, Israel, and Moskowitz, 2018, showed trading costs can erase 30 to 50% of gross alpha for capacity-constrained strategies. Survivorship bias. Using today's index constituents only can inflate returns by several percentage points per year versus a survivorship-free universe, as shown in multiple index studies. Look-ahead bias. Accidentally using information not available at the time can turn a flat strategy into a dream curve. Put simply, your backtest is a lie unless you explicitly defend it against these structural biases. Let's walk through what overfitting typically looks like in practice. Common symptoms. Sharp ratio above 3 on a daily traded strategy with simple logic and no clear economic story. Equity curve almost perfectly smooth, even during major market shocks. Strategy performance collapses as soon as you change parameters slightly. The first curve is what most beginners chase. Stable, almost linear growth. Max drawdown under 5%, and near zero losing months. The second curve has reasonable KAGR, say 15 to 20%. Drawdowns of 20 or 30%. Some ugly years. The key, the ugly curve is usually more believable. Real markets are noisy. If your backtest fits every wiggle, it's probably fitting noise. Robust testing requires structural discipline. Split data into in-sample, and design, and out-of-sample, validation. Do not touch the out-of-sample until you've frozen the rules. Expect performance to degrade out-of-sample. If it improves, be suspicious. Academic momentum, as in Jagadish and Titman, 1993, delivered about 12% average annual excess returns before costs in U.S. equities across multiple decades, but with large drawdowns and regime shifts. If your home-built intraday system shows 80% annual return, 5% max drawdown, and a sharp of 4 after costs, the burden of proof is on the backtest. Let's codify a more robust process using Python. The key ideas this code should capture. Use 3 segments: train, validation, test. Tune parameters only on train and validation. Touch the test set once at the very end. Build realistic slippage and fees into every order. From there, add techniques used by professional quants. Walk-forward analysis. Repeatedly refit on a rolling window and test on disclaimer. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Past performance of any strategy shown does not guarantee future results. Always do your own research and consult a qualified financial advisor before making investment decisions.